welcome to Indianomics. More often than not, when we speak of rising rates, we think of the poor borrower who boots a higher EMI. We don't worry much about poor depositor these days, who needs to be rewarded with some inflation-beating returns at least for his savings. Today, Indianomics takes a look at life from the point of view of the depositor. The savings rate in this country has remained at 3.5% since 2003, although inflation has always been above that figure. Isn't this an injustice to the depositor? The question we are asking today is, should the savings rate be deregulated? The other interesting headline this week was that RBI Deputy Governor, the able Mrs. Usha Thorat, has not been granted an extension. We look at the surprising decision of the Finance Minister and try to guess some answers. But first, the savings rate. Savings deposits comprise 24% of all the deposits in the country. 86% of this is held by households, the unsavviest of India's savers. 95% of these never move, and so the banks consider them core deposits. Despite all these advantages, they are paid the least, all of 3.5%. So, should the rate be deregulated? Joining me in this discussion are veteran banker Shikha Sharma, MD and CEO of Axis Bank, R.K. Bakshi, Executive Director of Bank of Baroda, and to present the non-bank expert view, Professor Jayant Verma of IIM Ahmedabad. Welcome all of you. Let me start with the lady. Shikha, what is your sense? If the savings rate is deregulated tomorrow, chances are the rate will go up?
Tough to say, Lata, because it depends on the broader interest rate environment. And if we look at the whole lending rate, borrowing rate, cost structure that banks carry today, 3.5% is what banks have built their business model around. So unless something were to change dramatically, I think banks will not find it easy to increase that rate a whole lot more. So in the current environment, I think the current environment in the current business model, 3.5 is what banking can support.
Well, 3.5 is really a mandated rate. It's not a market-driven rate. But let me get the others in first and then come back to you, Shikha. Mr. Bakshi, what's your sense? I mean, I see all the bankers clamoring for these low-cost current account and savings account deposits. Clearly, they're hungry for this rate. Do you think that if it is deregulated, it will go down? Chances are that it will go up?
I would tend to agree with the argument that it cannot be determined as of now, and it will depend a lot on the interest rate scenario. Let me give you an example. Till some time back, the term deposit rates, and even today they are low. Until some time back, the maximum rate was 6.5%. Today also, say 5-year term deposit may get you 7.25, 7.5%. So it's a 2 or 3% difference. The argument can be that the overall deposit rates in the banking industry do not cover up for inflation as it exists today. But saving bank is an operational account. Let us segregate the saving part of it from the operational convenience. It has become a much more powerful tool in the hands of the user, the deposit holder today. It's not only long back when the saving rate was reduced from 5% to 3% or 3.5%, I think it was 95, 96. The governor at that time had said that the saving bank is meant for operational usage, and those who want to earn rate of interest, they can put it in term deposits. Today, a number of banks are offering sweep facility from the saving bank account. And the total overall cost of deposits, the bank or the highest term deposit rate, if you compare to 3.5%, I think in some ways over a medium term, the rates can even move down. So this is a protection to the, when you talk of the unsavviest of the account holders, I think 3.5% provides not a bad floor today for their protection.
Okay. Well, that's a banker's point of view. I doubt it will be the depositor's point of view. It's certainly not my point of view. Dr. Verma, your thoughts, sir. Up front, would you say that a savings rate, mandated rate of 3.5% is fair, or would it be better to put it as a floor rate of 3.5% or whatever, and then let the market decide the correct rate? What would be your thoughts?
No, I think we must certainly deregulate that. This is among the few interest rates which are still administered. other than the small savings rate, this is the only one which is really administered. We ought to just deregulate it. I also believe that it will not make too much of a difference because I think if we go back to the mid-80s experience, a 15-day term deposit is a very, very close substitute to a savings bank account for non-operational balances. And we already have the data on that. If you look around at 15-day deposits, in many banks it is lower than 3.5. There are a few banks where it may be close to 3.5. So I think that competition is already there. If somebody was really interest rate hungry, they can always move it out into a 15-day deposit. Today you have the ability to move in and out of term deposits and savings bank accounts. So I don't think it will make too much of a difference. What I think will happen is that we will see proliferation of many different kinds of savings bank accounts. Just as you have many different kinds of credit cards, some in which you pay an annual fee and get a lot of benefits, some in which you don't pay a fee and you don't get benefits. You will have savings bank accounts which will give you a high interest rate but then don't give you many other benefits. You will have other savings bank accounts which say that the interest rate is low but I will give you, you can do unlimited withdrawals in any bank's ATM and you will have a priority loans and all kinds of that stuff. So that is what I would expect to happen. At today's scenario, I don't see deregulation of interest rates making too big a difference. Where it could make a big difference is if we get into a high interest rate regime. If we had double-digit interest rates, then yes, deregulating savings bank interest rates will make a big difference. But even there, I would doubt all that would happen is if it remained 3.5 and you had double-digit interest rates, is that a lot of depositors will move the non-operational balances into 15-day deposits. So I don't see this as a very big thing today. But I think we have embarked on a path of deregulating interest rates. We must just continue with that and let savings bank rates also be fully market determined.
That's exactly what has happened actually in a lot of countries. What you have seen is a very fine differentiation within the savings bank account itself. As Professor Verma, you said there will be accounts offered where you have unlimited transactions and a low rate, or higher rate and limited transactions. Basically, the market drives more innovation and maybe even better customer service. So, Shikha, let us assume that it gets deregulated tomorrow. What kind of a upshot would you see in terms of response to that product itself? Product differentiation?
If we look at the 7 to 15-day deposit rate today, the rates of interest range anywhere from 2% to 4%. So again, to come back and illustrate that, will interest rates rise as a result of deregulation? In the current environment, probably not. But I do think that it will give scope to package products based on different customer needs with different features. And that could be an interesting thing to see in the market.
Okay. Well, we need to take a break, but it is widely perceived that this 3.5% was mooted by the Reserve Bank in the past. 3.5 or 4% was mooted by the RBI in the past, primarily to protect banks so that some kind of margins are ensured for the banking system. Our experts say no, but we will belabor that point a little more after this break. Stay with us.